a 937 premium. Shanghai pays 81 to 88. COMEX prices 72.82s. That gap is widening, not closing. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver just printed a divergence that does not resolve quietly. Let's get straight into it. That spread sits at 12.92% right now. That is not noise. That is not currency translation. That is a structural signal. The data is doing the talking. Think about what that sequence actually means. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. Shanghai Gold Exchange benchmark pricing. $81.88 physical silver price. COMEX spot sits at 72.82 simultaneously. That creates a 9.37 premium. Effective immediately on latest benchmark. This follows a 6-month average premium of 7.68. That equals 10.29% over the same period. The unusual detail is persistence above average. Not a one-day spike, not a short-term anomaly. Sustained premium expansion above elevated baseline. The timing is what deserves scrutiny, not the event itself. The timing. This premium exists despite arbitrage incentives. Shipping costs sit between $1 and $2 per ounce. That leaves a theoretical $7 spread unclaimed. That arbitrage is not closing the gap. That is not coincidence. That is a pattern. Physical silver demand remains elevated relative to available supply. The market that takes delivery is pricing higher consistently. What does it mean when physical buyers ignore futures pricing? What does it mean when delivery markets diverge from paper benchmarks? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time sustained physical premiums exceeded 10%, supply constraints followed. The data is already telling you something. Let's build it out. Now let's build the full picture because Shanghai pricing does not exist in isolation. Shanghai Gold Exchange benchmark data confirms $81.88 physical pricing. COMEX futures data shows $72.82 spot pricing simultaneously. CME Group warehouse reports show 77 to 80 million ounces registered inventory. COMEX open interest data shows 550 to 575 million ounces equivalent exposure. That implies roughly 7-to-1 leverage. That gap explains the arbitrage failure. LBMA vault holdings show larger totals, but not immediately deliverable. Shanghai Futures Exchange confirms elevated local demand flows. 6-month premium average sits at 7.68. Current premium exceeds that baseline by 1.69. That is acceleration relative to an already elevated trend. The rate of divergence is not slowing, it is persisting. That is the key detail. The data is doing the talking. The ones who have been called early for focusing on physical markets, they are not being dismissed right now. The ones who verify do not argue about it. And here is what makes that picture even harder to ignore. Physical pricing leads futures pricing in delivery markets. 7-to-1 leverage exists in COMEX paper positioning. At the same time, futures markets remain liquid and dominant for price discovery. That is not a contradiction. That is the setup. And before anyone takes that as a directional signal, timing remains uncertain. Premiums can persist longer than expected. Arbitrage constraints can hold longer than models assume. What this tells you is the structural imbalance. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Sit with that. Here is the number most people are not talking about. 21 million barrels per day, moving through one strait. Now Strait of Hormuz escalation, because this is no longer a backdrop. It is the primary variable. Iran-related disruptions extend into a 10th week. Brent crude rises above $100 again. One session prints a 5% move higher. That feeds directly into inflation expectations. U.S. 10-year yields hold at 4.44%. The US dollar index holds between 98.05 and 98.54. The Federal Reserve holds rates unchanged with internal division. Barclays forecasts 0 cuts in 2026. That combination supports dollar strength structurally. Strong dollar suppresses commodity pricing in futures markets. But physical demand in Asia remains elevated regardless. That creates the divergence. Markets are still pricing stable supply assumptions. Look at the Shanghai premium and test that assumption. When markets start pricing persistent inflation risk, metals reprice structurally higher. Gold typically leads that move. Silver follows with higher volatility. Every time sustained inflation pressure persists, metals eventually reflect it. It has not been different yet. Think about what that sequence actually means. Silver Western spot at 72.82. Shanghai physical benchmark at 81.88, 937 premium. Short-term picture remains conflicted. Macro headwinds suppress futures pricing. Physical demand supports elevated real pricing. Key level remains $75 on COMEX. If $75 breaks with sustained volume, momentum shifts upward. If $68 breaks, downside liquidity expands first. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. Current conditions remain compressed and reactive. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that costs you. So let's run both. The bear case is real. DXY holds near 98, supporting dollar strength. US 10-year yields at 4.44% pressure metals valuations. Federal Reserve signals no cuts through 2026, maintaining restrictive conditions. The bull case is equally real. Shanghai premium sits at 937 above COMEX pricing. COMEX coverage ratio remains near 13 to 14%. January withdrawals removed 33 million ounces, tightening supply structurally. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one conclusion. Physical pricing is leading paper pricing under structural constraint. The only variable is when convergence occurs. Don't take my word for it. Verify every number I gave you today. Check the data yourself. Shanghai Gold Exchange benchmark data, CME Group warehouse reports, COMEX futures open interest data, logic over hype, always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.